Welcome back. Shares of Apple, they're falling after the company's second downgrade this week, this time from Piper Sandler, citing iPhone sales and its valuation. The rest of the Magnificent Seven also slipping to start the year, as you know. That index down 3% year to date. Let's bring in Corient's Amy Kong to further discuss. Happy New Year. Welcome back.
Happy New Year.
Okay, so top holdings include Alphabet, Apple, Microsoft, and NVIDIA. Are you getting a little nervous?
In the short run, of course, there's likely to be room for some of these stocks to slip, and we've already started to see that into the new year. But longer term, we do think that they have good fundamentals, good growth prospects, good cash flow, which I think is very key in this kind of market, and so we are long-term holders.
Do you feel like you have a good handle on, I know you have to sort of judge all of these individually, what their valuations should be, in quotes, right? Many of them are trading well above their 10-year historical averages, whether it, Apple at 28.5 times or somewhere around that. But you get the point of where I'm going with that. You have in your mind, like, okay, I think this needs to correct to this level, and then I think it's going to be fine?
Yeah, it's a great question. We think about price to earnings ratio in an absolute term, historically speaking. We also look at PEG ratios, which is very important, especially names like NVIDIA, where the PEs are very high, but from a PEG ratio perspective, it's a little bit more moderated. And so in general, we are comfortable buying into these names, not now, but in the past, buying into these names, knowing that the growth is likely to grow into the multiple. But again, my point being the cash flow and the balance sheet being so robust, in our opinion, these are really key attributes to have in this kind of uncertain market.
Would you urge people to sort of sit back and just relax for a little bit, watch these things settle out before adding new money? Because, the last couple of days, I'm looking at Meta, for example, which you don't own, but, Meta's green. And at a couple times, NVIDIA's green. Yesterday, it was Microsoft and Alphabet. We're green. So there's a little, putting toes back in the water there. But would you suggest just sort of sitting back and relaxing for a little bit?
Yeah, that's spot on, Scott. We are pausing on any new dollars going into this group of stocks. In general, the market, after this great burst of optimism from last quarter, is now sitting at a price to earnings ratio of 20 times this year's earnings. It is a little bit high from an absolute standpoint, a little bit high from a historical standpoint. And so we need to see earnings grow into this multiple. And so we're really looking for opportunities outside of the Mag 7 at this point. And so healthcare, maybe financials, could be areas of interest for us for the time being.
Do you feel like earnings are going to meet the moment and grow into the multiple? I mean, obviously that banks on the economy remaining strong enough, margins holding up, revenues and the like?
Yeah, it's another great question. I think for the moment, the market is expecting almost an 11% growth from 23 to 24 earnings. The next couple of weeks, even months, will be very key for us because management teams are prepared to talk about last year, which we think will be okay, but really the focus will be what's going to happen this year. And I do think that there will be some adjustments to the 24 numbers. So from my perspective, it's going to be very important to watch what that's going to look like. And we do think management teams will lean more conservative.
What about rate cuts? What are you sort of expecting, right? The market's expecting one thing. Maybe the market's a little bit ahead of itself with, 6 at least cuts starting in March. Does that sound too optimistic to you?
It feels a little optimistic at the moment, considering where the valuation levels are. I think the Fed is doing the right thing by trying to take back a little bit in terms of the minutes that were shown just more recently. In our opinion, I think the key is really to make sure inflation is getting back to that 2%. We haven't gotten there yet and has to get there and stay there. I think the Fed needs to be very careful not to declare victory on inflation too prematurely.
So then on that note, you obviously aren't expecting that many rate cuts.
No, we're not.
How many do you think are realistic, and what do you think that means for the trajectory of the market in 24?
I can't tell you at the moment because the inflation data is still coming in, and we haven't even gotten back to 2% yet, which is their long-term target. I think the Fed is not trying to say we want to get near 2%. They want to get to 2% and stay there at a sustainable level. And for us to really think about rate cuts, we do need to see that data continue to flow through. So I think for the moment, maybe between 1 and 3 is reasonable, but 6 is obviously, from our perspective, a little bit beyond what we're comfortable with.
What kind of overall year do you think we're going to have then in stocks?
We think that it could be a positive year. Certainly, we don't think it'll be a repeat of 2023. Considering that earnings are likely to be positive from a growth standpoint, I don't know if 11% is where we're going to get to, but if it is positive, we do think the market should have a reasonable year. Another aspect to think about is the fact that it is an election year, and not to say historical performance is an indication of future, but historically speaking, when there is an incumbent candidate running for president, the S&P has landed in positive territory for the year. So that's something to keep in mind as we walk through the next couple of quarters.
It will be fun to watch, and I'm sure we'll do it with you.